Hi, my name is RJ Mathews, and I am doing my report on the Sarbanes-Oxley Act and its implications on accounting practices and standards. On July 30th, 2002, in response to multiple accounting scandals in the early 2000s, the U.S. government enacted the Sarbanes-Oxley Act, which is also known as SOX. Um, I think that the major contributors to the accounting scandals in the early 2000s were two major factors. Number one was audit independence, and number two was lack of internal controls. First, in talking about audit independence, I'd like to mention that accounting firms traditionally and rightfully so have been entrusted by the public to be watchdogs and to report fairly financial situations. This lack of audit independence resulted from firms who were engaged in audit activities and otherwise also engaged in non-audit services as well. Non-audit services included consulting services, tax preparation services, and others. An example of this is Arthur Andersen with Enron. In the year 2000, Arthur Andersen collected a total of $52 million in billings from Enron, 27 million of which were for non-audit services. Clearly, audit independence would have been affected by those revenues from these other non-audit services, which would have been affected if they couldn't engage and properly or report how Enron wanted the financials. Secondly is the lack of internal controls that existed within corporations. Prior to Sarbanes-Oxley, management and executives weren't required to even review internal control measures. And this was a result of weak standards that existed for the governance of internal controls. Additionally, external independent auditors were not required in any way to review the internal controls. And these lack of standards encouraged cooking the books and manipulating numbers, which in turn led to large bonuses not only for corporate managers but also for auditors engaged in auditing those companies. Sarbanes-Oxley has addressed these issues, clearly stating that accounting firms are not to engage in non-audit services for their audit clients. It also sets forth pre-approval requirements for non-audit services. It also states that audit partners may not oversee audit services for the same client for more than 5 consecutive years. This further ensures audit independence and an ability to offer an unbiased and objective opinion on a company's financials. Sarbanes-Oxley also says that accounting firms that employ former executives of publicly traded companies cannot audit. Executives of a publicly traded company cannot audit that company in a period of a year. And Sarbanes-Oxley addresses internal controls by requiring management to review and submit filings to the SEC periodically. This is interim financials or interim filings and annual filings. This involves management in the design and implementation of internal controls, and furthermore, Sarbanes-Oxley requires that external auditors review those internal controls and offer professional opinions on the effectiveness of those controls. Sarbanes-Oxley is a major step toward restoring public confidence in corporations and accounting firms after the scandals of the early 2000s.